Hi, Econ class. As promised, here are a few slides to help you do two things. First, I wanted to remind you how much we have already learned this year and get started with some review. Second, I wanted to remind you that now, as a result of having studied econ for the past 7+ months, you have the analytical tools necessary to understand all of the craziness that's going on in the world right now. So we're going to look at the economic consequences of the current pandemic and the measures taken to prevent its spread, as well as to help the U.S. economy, with the help of the economic concepts we've been studying all year. Ready? Here we go. Wait, instructions for this video. You want to have out your notebook and a pen. I'm going to ask you questions during this video. So what you'll do is you'll pause the video and think for a minute, flip backwards in your notebook to see if you can come up with the answer yourself, then hit play again. Okay, now let's continue. So you may remember that before we even started discussing macroeconomic theory, we started simply by looking at the data to help us figure out whether or not an economy is doing well. Remember? You all did that for your own economies, and we did that for the US together. We looked at GDP, inflation, which is measured with CPI, unemployment and employment numbers, wage growth. Remember that? Now, here are some current indicators at a glance, and we'll go over them in more detail in a moment. The 2019 numbers are data that has been measured. The 2020 numbers are what was forecast last Wednesday by the Conference Board, a nonprofit think tank that does economic forecasting. And you see here at a glance that the US economy in 2020 will look very different from the US economy in 2019. So you see, for example, in 2019, we didn't have amazing growth, but we had pretty decent growth, right? So we see we had solid growth of 2.3%. That's going to look very different in 2020. We had very, very low unemployment numbers in 2019. That's going to look very different in 2020, and so on and so forth, right? And we can look at this data in a little bit more detail. Before we start looking at the data a little more closely, we quickly need to remind ourselves again what some of that data means, and this is part of your review. Let's start with GDP. Can you remember the definition? You may want to pause here for a bit to allow yourself to retrieve that information from your brain or from your notebook. Our textbook's definition for GDP is the following. GDP is the market value I should zoom in here a little bit, of all final goods and services. Are you writing this down? And remember, we said not all goods and services are included here, right? Intermediate goods and services are not included, and illegal goods are not included, and then things that you do as a favor to someone or volunteering is not included. I will tell you, all the homeschooling services that my husband and I provide at the moment are not included in GDP. But so all final goods and services that are produced within a country's borders, so within borders, remember this is the example that we talked about with my dad going to Golf Galaxy on Rockville Pike buying golf clubs. That is part of US GDP, but not part of German GDP, right? In a given amount of time. And most of the time, we're going to look at GDP for either on an annual or a quarterly basis. Today is April 1st. Second quarter of 2020 is starting today. And this is going to become significant later on when we talk about what they're forecasting for 2020. They are forecasting that the second quarter of 2020 is going to be the worst quarter. So think of either quarterly data that we want to look at or annual data. Okay, so that's the definition of GDP. Remember, in order to assess the U.S. economy over time, over a long period of time especially, we usually want to use real GDP, which simply means that we're looking at the value of goods and services produced, taking inflation into account. So essentially subtracting the growth of the money supply. So that we can easily compare how many trucks were produced in 1950 versus how many trucks were produced today, for example. We also often do not look at the absolute number of GDP, right? Which in the US in 2019 was around $21 trillion. We're the biggest economy in the world, or roughly around $65,000 per capita per person. But economists are often more interested in growth rates. How has the economy changed over a period of time? Have we made more stuff or less stuff? If we have managed to make more, that often means that more people were part of the economy, meaning we had fewer people unemployed and more people at work. So positive growth rates are a good thing. And you want to take a minute and try to remember what we consider good growth in the US, and maybe even try to remember for your own country, the countries that you're working on, what is considered good growth for them. So take a minute and think about that. Okay, before we move on, let's look at one more definition of GDP, which you all know is my favorite equation ever. So I'm just going to erase this here so it doesn't look so messy. What is the definition that I'm after here? How do economists think about the components of GDP? You might want to pause the video here and say it out loud to everybody in the room, then resume. Did you do it? Say it with me. The equation for GDP is, what is it? Y equals C plus I plus G plus NX. At this point, I hope you know what all of these components mean, no? Can you also tell me what the biggest component of this equation is for the US economy? What is it? It's C. It's consumption, which in the US nowadays is somewhere between 69 and 70% of GDP. For the US, consumption is super important. You want to keep that in mind. So let's look a little bit more at this forecast from the conference board. Let's look at it in a little bit of detail. GDP. So here you have a graph of historical real annual GDP growth figures from the St. Louis Fed, right? The Fed database that we always look at together. You know what the shaded areas are, right? They are recessions. When are we in a recession again? Do you remember the definition? A recession is defined as 2 consecutive quarters of what economists non-ironically call negative growth. So you see here during the 2008 recession on an annual basis, negative growth was negative 2.7% in 2008 here. During the worst quarter in that recession, and I don't have quarterly data here, this is annual data. During the worst quarter in that recession, which was the fourth quarter of 2008, the economy shrank by negative 8.4%, or I should say it shrank by 8.4%. That is significant. And I have told you in the past that people felt that. It hurt. It affected real lives. People lost their homes. People lost their jobs. People lost their livelihoods. Now, what are we looking at for 2020? Well, the Conference Board tells us that on an annual basis, real GDP, so the amount of goods and services that our economy produces, will shrink by almost 6% in 2020. On this graph, you cannot find a single year during which the US economy has contracted by as much. On a quarterly basis, and you might have heard this in the news, the numbers look even scarier. In the second quarter, the Conference Board expects the US economy will shrink by 30%. 30%. That's a third of goods and services produced less than what we usually make. And that prediction is similar to predictions that we've heard recently that were done by economists at Goldman Sachs or JP Morgan. I should say here, not to be too scary, that yes, that is a very, 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 very scary number, but it doesn't mean that the economy is going to be forever reduced by a third, right? These forecasters believe that once the crisis is over, and there's no certainty around when that might be, there will be a huge catch-up effect and very fast growth rates for the 2 quarters to follow that worst quarter to make up for some of what we have lost. That said, the annual reduction in GDP by almost 6% for 2020 is real. And as you see here in that graph, we've never seen something like this in recent memory. And again, it means that people will feel this and will hurt. That's significant. The first place where we will see that is the labor market, of course, right? I told you earlier that the more we produce, the more people are benefiting, the more people are employed. And then, of course, the opposite of that is also true, which is we produce less, fewer people are working, right? You may have heard some very scary predictions of 20% unemployment. Recently, I have not seen figures of that magnitude, but the forecasts look pretty grim. The Conference Board predicts an average unemployment rate for 2020 of 7.2%. As you will see here, that is not quite as high as unemployment got during the last recession. But remember that we had said that there were still many people in the US economy who had never rejoined the labor force as a result of being discouraged by the dim job prospects in the wake of the 2008 recession. So 7.2% is pretty bad. And when compared to the 3.4% of last year, which we had said, remember, resulted eventually in some wage growth, which was good, this is not good news. Quickly before I move on, do you remember how we define unemployment? Do you remember? What is unemployment? The BLS, the Bureau of Labor Statistics, defines as unemployed those people who don't have a job, have actively looked for work in the prior 4 weeks, and are currently available for work. So that is why in the definition of unemployment, we will not see discouraged workers who have given up looking for work. So you might want to write that down in your notes here, that definition. That's important. When are official unemployment numbers coming out? They come out on the first Friday of the month, which happens to be this coming Friday, right? So I expect you to pay attention to the news. Okay. Let's start to get into some theory to understand what's been going on most recently. And we're going to do that with some graphs. So in the next series of graphs, I want to use our aggregate demand and aggregate supply models to explain what has happened and then show how policy might react to it. So what has happened? Let's graph our usual aggregate demand and aggregate supply model here. You can draw it with me in your notebooks. So let's do this. Maybe I'll do black, easier. We'll do a y-axis. Answer how do we label this y-axis? It's P, right? It's the price level. And then we are going to do a beautiful x-axis. What is on the x-axis? It's Q, right? It's output. You could also say Y or GDP, right? Then we're going to do aggregate demand, right? Downward sloping. How much people want to buy at any one point, right? And we're going to do supply, which is upward sloping aggregate supply. Note this is short run aggregate supply, right? We're not going to get into why we have different long run aggregate supply and short run aggregate supply, but just for completeness sakes, I'm going to put, oopsies, wrong. I'm going to put the long run aggregate supply curve here. We are talking about a recession, which we consider short term. So we're going to focus mainly on the short run aggregate supply and aggregate demand. Okay, here we go. So what has happened as a result of physical distancing and shelter-in-place orders and people generally being afraid to get sick, and more policies designed to stem a further spread of the pandemic? What was the effect of that? Can you answer in your head? The effect, of course, was to slow down aggregate demand massively. How should we draw this on this graph? Think for a minute and do it. Yes, we want to shift aggregate demand to the left as a result of everything that's going on, right? So we're going to draw a second aggregate demand curve. We can label this AD2. And this can be AD1. So what does this result in? So if we are going to figure out, what are the outcomes for our economy, I'm going to do this way. We had maybe the equilibrium output here. And then what do we see here? That's the reduction in growth that we just talked about, that we see in the forecasts and in the data. Here's the price level. So we see a massive reduction in output, and then we see a downward pressure on the price level, right? Let's quickly think about the components of GDP to understand why this is the case. Why does aggregate demand shift in this direction? Why does it shift in to the left here? So first we think about, remember, what is the biggest component of GDP? It's C, right? Consumer spending already is way down. Remember from the data at a glance table that that I showed you at the beginning of the lecture, that the Conference Board predicts consumer spending to fall by 7.7% this year and by 40% in the second quarter, which I told you starts today on April 1st. Investment is also most likely down, right? With all of this uncertainty. So C is down, I is down. With all of this uncertainty, businesses are less likely to make big investments at the moment. And people, despite low interest rates, which we'll talk about in a minute, are going to be less likely to want to buy houses or make other large purchases that require them to take out loans or to spend a lot of money, right? So you can imagine if you're at all worried about losing your job anytime soon, you're going to want to not be buying a new dishwasher at the moment, right? Okay, I'm going to clean up this data a little bit and let you think about, maybe, do I need to clean this up? Maybe you can follow me if I switch colors. So what can fiscal policy do about this? Before we get into that, can you tell me again who makes fiscal policy? Who does it? And what is it? Pause the video here and think for a minute. You knew it, right? Fiscal policy is decided by Congress, and it can involve either the raising and lowering of taxes, T, right? We're going to keep the government in green. Taxes can be lowered or raised, or Congress can decide to lower or raise government spending, right? What has Congress decided? They have decided to expand government spending by a lot, 2 trillion, which is a historic number. I sent you a marketplace.org summary of what's in that big stimulus bill. What is in it? It's direct checks to American citizens, an expansion of unemployment benefits, aid to small businesses and to large corporations, and $150 billion to assist healthcare, so to assist hospitals and other healthcare providers during the pandemic. That's G. The government has also postponed the due date for tax returns, so people don't have to do their taxes until June. Okay, so that's the stimulus bill. How are we going to put this on our chart? What will be the effect on aggregate demand? Can you think? Can you do it? Yes. Aggregate demand should move back to the right, hopefully, right? We don't know by how much. We hope that it's going to restore original demand, but we don't know. And I actually drew it a little bit too far out here, but that has to do with my not wanting to make my graph too confusing. So we hope that that aggregate demand will shift back to the right. Probably, unlike I have drawn it here, we will not make up all of the lost ground, but it should help. Before we move on here, we need to talk about 2 effects that might ring a bell for you. And those effects are the multiplier effect and the crowding out effect. Do you recall what we mean by those? First, let's talk about the multiplier effect, which is pretty straightforward. And I hope that you remember. That just says that for every dollar that the US government spends, there will be a bigger than $1 effect on the macroeconomy. So take, for example, the checks the government will be sending to some Americans. If a family ends up spending that money, some other participant in the US economy will receive that money, right, in exchange for the good or service that they're providing to that family. Then they will spend that money on something else, and so on and so forth. So the multiplier effect has the potential to push out the AD curve, the aggregate demand curve, by more than the original amount of government spending. But we have a problem, right? The problem is the so-called crowding out effect. Do you remember what that is? I'm not going to draw a graph here to confuse you even further. But basically, in a nutshell, the crowding out effect just says that all of the government borrowing that is now necessary for the government to spend all of that money will put upward pressure on interest rates and thus make it harder for private businesses to get their hands on loans, thus possibly dampening aggregate demand. So kind of counteracting the effect that all the spending by the government might have, right? And it's hard to predict by how much that will happen. But that is the crowding out effect. So we have said C has gone down, I has gone down, But as a result of the stimulus bill, G has gone up massively, right? And with the effect, hopefully, of buffering some of that reduction in aggregate demand that has led to and will lead still to this drop in output, right? Okay. To counteract some of this, to help aggregate demand, but also to help interest rates, which might be crowding out some investments, luckily have monetary policy, right? Can you tell me who is responsible for monetary policy? Yes, correct. It's the Federal Reserve. And who is the chairman of the board? Remember when I asked you who they were called? I'm expecting all of you to remember who the chairman of the board of the Federal Reserve is. It's not Harry Potter. It's not Janet Yellen. It's Jerome Powell. And what has the Federal Reserve done lately? They have slashed interest rates close to zero. Which one, and you have to review here a little bit, is the interest rate that they control? Look it up in your notebooks. What is it? It's the so-called federal funds rate, which is the rate at which large financial institutions borrow loanable funds from each other. How does the Fed control this rate? Look it up. Yes, they control it by open market operations. Let's draw this in. Here, you can do this in your notebooks. Follow me. So what is the y-axis when we want to think about open market operations? And what is the x-axis? The x-axis is, and I'm going to just zoom in a little bit so I can write more easily. The x-axis is the amount, the Q, of loanable funds. And those are the funds that banks loan to each other so they can then make out loans to their customers. Excess reserves, you might say. That's the Q. And the Y is the price for those funds that the banks loan to each other, which is the federal funds rate. Now we have to figure out what the supply and the demand are. So the supply is simply the excess reserves that banks have that they can loan to their other banks. If the other banks are in need of liquidity to make loans. So excess reserves, or you could think of them as, this is supply, right? Come on. Excess reserves or extra loanable funds that banks have available. Now, what is the demand? The demand is simply the demand by other banks for loanable funds, right? So demand is demand for loanable funds. And then I'm going to show you the equilibrium in a minute. So the equilibrium that we have here is we have an equilibrium quantity of loanable funds, and then we have the prevailing interest rate, and I'm just going to call this R, lowercase r, for the federal funds rate. Now remember that the federal funds rate is the determining interest rate in financial markets. So all other interest rates are layered on top of that. So treasury bond yields follow that. Prime rates, which are the best rates that banks charge their best customers, are layered on top of that. So all of the other interest rates that exist in the market follow this federal funds rate. Now, what has the Fed been doing? The Fed has been buying bonds and other financial assets from financial institutions. What does that mean? They exchange money, loanable funds, and pump those into the financial system in exchange for assets that are not as liquid. So they're buying bonds, they're buying other assets from the banks, and then giving the banks access to cash, access to loanable funds in return. What has that done? It has shifted supply of loanable funds out. Now more banks have excess reserves as a result of the open market operations. I'm going to write that term here so that you don't forget and you know what it is. So the Fed does open market operations, and those shift the supply out, the supply of loanable funds out. Now, what happens? Oops, I did not want to do that. What happens as a result? The equilibrium rate, the equilibrium is now at a different spot, right? So the new equilibrium here is more loanable funds are available, and our interest rate is much lower, right? And remember, this goes for all of the interest rates in the economy. Why do we want lower interest rates? How does a lower interest rate influence aggregate demand? And I could now layer on another aggregate demand picture here, but I think you can imagine it in your head. What does this do to aggregate demand? It increases aggregate demand because it increases investment, right? So aggregate demand, hopefully as a result of this, of these open market operations, of the lowering of the interest rates, hopefully that will help investment and shift aggregate demand out to counteract these contractionary pressures. Okay, so look at this in reality a little bit. Currently, interest rates are close to zero, and I think they were at 0.09% on Monday, and we haven't seen this really since February, and the graph doesn't even go that far, but we haven't seen interest rates this low since February 2012. Before we move on, I wanted to talk a little bit about aggregate supply. And here we have to be careful not to confuse aggregate supply, which encompasses all producers in the economy, with the supply of concrete goods and services, which we can look at when we talk about microeconomics. What has happened to aggregate supply, do you think? What has happened? And we can, now I'm just going to do short term because I don't want to make the graph too busy. So we have GDP here, that's Q or Y. We have the price level here. We have aggregate demand here, which we know has gone down. I don't need to shift that to the left for you now because we're interested in the supply side now. So this is aggregate supply. What do you think has happened to aggregate supply? Yes, it has also shifted to the left. So this would be aggregate supply 2. The left shift has to do with the fact that so many of our goods that we make are partially produced overseas, and across the board, manufacturers are experiencing what we call supply chain disruptions. They cannot get their raw materials or inputs for their goods. And if you think about service providers, with the exception of healthcare providers, their supply, quote unquote, has also gone down because they had to close their businesses. So we could draw this, as I did, as a leftward shift of the aggregate supply curve. Note with demand stable, as I have drawn this here, this could lead to inflation, right? Because the price level as drawn here would shift up. But because we have such a severe reduction in aggregate demand, we do not see that upward pressure on prices right now. So we think that the reduction in aggregate demand has been so significant that we don't see prices going up. And inflation was already really low before all of this started. Okay, before we move on to microeconomics, let's quickly take a look at financial markets. Recall that for the overall economy, the financial system has the role of channeling money from savers to investors, right? Or borrowers. The savers save for a variety of reasons: to afford college, to maintain a standard of living upon retirement, to eventually buy a house. The borrowers take those saved funds to invest in the real economy, to found and expand businesses, to do research, to make inventions and discoveries, right? So this is the I in our GDP equation, and it's also very important for economic growth, for long-term economic growth for the economy as a whole. Without having savings, we don't have investment, and without investment, we don't have long-term economic growth, and which will then lead to a higher standard of living. Now, the part of the financial system that has attracted the most attention really is the stock market, right? Currently, as a result of this crisis. And you have all followed this as being players in our stock market game. So let's look at what has happened. We know that stock prices in general reflect expectations of future profitability. So if participants in the stock market think that Tesla is going to be this vastly profitable business in the next 10 to 20 years, they're going to want to buy Tesla shares, and that will drive prices up, right? But the aggregate demand contraction, this is sort of a businessy term that we're currently seeing. The aggregate demand contraction that we're currently seeing, so the reduction in aggregate demand, is now lowering the expected profits for all of the companies, and stock prices are dropping, right? Uncertainty is not helping matters one bit right now. What does help expected profits for companies is that higher unemployment has meant that there is now again downward pressure on wages. So that means that costs are reduced for companies because they can get away with paying lower wages because there are more extra workers available, and that might help profits a little bit in the long run, and then also might help with stock prices. But as you have all experienced, stock market indexes like the Dow Jones and the S&P 500 have been falling. And some stocks have been especially hurt, right? Anyone in the travel industry has seen their stock prices completely decrease. And then some assets are on the rise, right? We talked about Clorox. You can imagine that Zoom Video Communications, and this is their ticker symbol, is doing pretty well. And here are the major indices, which an index is just an average of a bunch of stocks, right? And how they have performed. Note that this kind of drop in the stock market, of course, also weighs on aggregate demand, right? Savers who hold their savings partially or to a large degree in stocks will now feel less wealthy. And that will obviously mean that they will reduce consumption, right? They will curtail their spending. Okay, let's turn to micro. Micro, as you know, microeconomics is looking at individual markets for individual goods or services and how some of these markets have been affected by recent events. And a lot of you have been doing that for your ELPs, which I'm reading currently, and they're super interesting. Okay, first, let's look at supply and some of the goods that have been in the news recently. Note that when we talk about supply curve shifts, they shift mostly due to a change in input costs, right? What has been in the news lately is especially drug shortages, because a lot of the inputs for drug manufacturing actually come from countries like China and India. So those input costs are going up because of supply disruption. And then you've all heard about the protective mask shortage. So when we think that when inputs become more expensive, what happens to supply? What does happen to supply? Let's do this. You can all draw this with me, right? We're going to have, remember, now we're not drawing a, this is the wrong pen I'm using. We're not drawing a aggregate demand and aggregate supply graph now. We're in the microeconomics world now. So we're drawing Q for one particular product and P for one particular product. Let's make this masks, protective masks. And then we are going to focus on supply, right? I know we can also say a lot about demand here, and we'll do that in the next graph. But let's just say this is demand. It goes down as it goes up, right? It moves in this direction as prices go down. And let's do supply, which is upward sloping, right? Supply of protective masks, which of course goes up in this direction. This is how Q is moving as prices go up because I'm willing to sell more if I can fetch a higher price for it, right? Okay, so what is the effect of higher input costs on suppliers? Can you tell me? Yes, supply shifts to the left, to the window, right? So this is a shorter supply. What do we see, of course, as a result? If we look at this on the graph, we see that the quantity actually goes down and the price goes up, which is exactly what we have been seeing, and which is so problematic for healthcare providers especially, right? Because they're put in harm's way. Now, we should also mention, and we can do this in a second graph, that, of course, what makes this situation even worse is that demand has gone way up as well, right? So if I were to make this graph even more complicated, we would find ourselves here at an even higher price again, which puts a lot of healthcare providers in a difficult position. Okay, what's happening to demand? Demand for certain goods and services that has shifted as a result of the current crisis. So you've heard about toilet paper, which was short for a while, but actually is not so much a problem. Stores have figured out how to get their hands on more toilet paper, but there is in fact a hand sanitizer shortage right now, and that has mostly to do with an increase in demand. So let's do that graph. Do it with me. So we're going to draw a the price on the y-axis, the quantity on the x-axis. Please always label your graphs. we have demand for hand sanitizer sloping downward because it expands, the demand expands as prices go down, right? That law of demand. And then we have the supply of hand sanitizer, which supply increases as prices go up. And we have an equilibrium quantity, and we have an oops, what did I do? I wrote y-axis instead of price. It says price. We have an equilibrium price as well. Now, what happened with the coronavirus crisis? Someone like me who just prefers to wash their hands with regular soap rather than using hand sanitizer all the time would have started to demand hand sanitizer, and I'm probably not the only one. So how do we draw this on this graph? Correct. Demand has shifted way out, right? And we can maybe draw the effects of a shortage here. So if this is 0 and this is 1, so at the old price, let's say maybe like places like CVS or Safeway or even Amazon are reluctant to raise prices to the equilibrium market price. So let's look at what happens at the old price if they don't adjust their prices. At the old price, the quantity demanded, is all the way over here, right? But at the old price, quantity supplied is here, right? So we have the scenario where quantity demanded is way bigger than quantity supplied. What do we call this scenario in economics? What do we call it? A shortage. So we are seeing a shortage of hand sanitizers. Now, what is the solution to this? And we actually saw Stonewich alums featured as part of the solution if you're paying attention to Stonewich social media. So one solution, of course, would be for CVS and Safeway and everybody else to adjust their prices and allow the price for hand sanitizer to go way up, right? But we wouldn't like that as a nation, as a country. We want everybody to have access to affordable hand sanitizer. So what is the solution? And you might have seen this in the news, but also, as I said, on Stonewich social media, the solution is what has been happening is distilleries that usually produce alcoholic beverages have shifted their production to making hand sanitizer. How would we portray this on this graph? And we're going to make this graph even messier and even more complicated. How would you portray this on this graph? Correct. You would shift supply out that way, right? Supply, more participants, more suppliers are joining the market to maybe make more hand sanitizer and make it available at an affordable price. Pretty neat, right? You have all the tools to analyze everything that's happening. I quickly want to erase this and talk to you a little bit about elasticities, and maybe we can draw that as well. What do you think? How has elasticity shifted? And here I'm mainly interested in elasticity of demand, not elasticity of supply. How has elasticity of demand of hand sanitizer shifted as a result of the current pandemic? Can you tell me? And remember, I just told you I am not usually someone who likes to use hand sanitizer, but all of a sudden I am, right? What are the characteristics, or what are the factors that determine elasticity? Can you quickly review them with me? One is, actually I want to write this in black. One is it a luxury or a necessity, right? Are there substitutes? So in this case, what would be the substitute for hand sanitizer? It would be regular soap, right? I necessity, I already said. I would say those are probably the main things that we want to think about, right? Now, what do you think has happened as a result of the current pandemic that we're talking about? What is going on now? I would say probably we have gone from demand that looked this way, right? Fairly elastic. I mean, not infinitely elastic, but fairly elastic, to demand that has probably gone a little bit less elastic, right? And I'm exaggerating here. So the elasticity has changed. Remember, what is the definition of elasticity? Can you see if you can recall it? It's the percentage change in quantity demanded over the percentage change of price. So if price were to go up, right, it's basically the slope. If price were to go up a lot, so let's say from here to here, how would consumers react? With the old, the flatter curve, right, if price were to go up from here to here, we would see a pretty big reduction of demand, right? But that is not the case as the elasticity of demand decreases, as demand becomes less elastic, less reactive to price, right? So if I were to do this here, if the price, I'm now looking at the less elastic curve, if the price were to go from here to here as a result of shortages, right, and shifting of demand, you see that the reduction in demand is much, much lower. So that's how our elasticity analysis can help us understand economic consequences of the current situation. Okay, I think I've given you a lot to think about. I hope this helps, and I hope you really see how much work we've already done during this year. We really have done so much, and I'm so proud of you. And I hope you see and congratulate yourself on how much knowledge you have already put into your heads this year. If you have any questions, obviously be in touch with me. I hope you found this useful.